talk to you about China, and you say it's been a long time, almost 7.5 years, but the moment has come for us to downgrade the MSCI China. You call yourself the perma bulls as far as China is concerned. What's made you change your mind after 7.5 years?
I think some clients have called us perma bulls, but we were actually just trying to remind clients that we've not always been bullish on China. So that downgrade that you're referring to, we did in November '07. And it is a long time since we've downgraded China, that's true. But at that point, China was very, very expensive to other emerging markets and at the top of an economic cycle. China's not super expensive right now, but it has closed out its valuation discount to other emerging markets. So it's trading on about 12 times forward PE. But actually, unlike India, which is on a higher multiple, but where we do expect earnings growth going forward in India to accelerate, what we're seeing in China right now is a deceleration still in the economy and in corporate ROE. And in earnings growth. And so with that equity valuation re-rating and with the very strongly technical overbought situation in the China markets, both onshore and offshore, that's why ultimately our model's calling for us to take some profits here.
So how much correction do you anticipate as far as the Chinese market is concerned? And once again, the macros disconnected with the kind of surge that we've seen in the equity markets.
Yeah, so I think when you look at the onshore markets, the Shanghai market, when we wrote a piece about 10 days ago about risk-reward deteriorating, the Shanghai A was at about 4,500 on the composite. And we talked about a range of 4,000 to 4,800 for the end of the year. We've had that as a range for some time, and we were worried that we were getting towards the top end of that range. We've already come down to about 4,200, and we hope we can settle around in that range going forward. For the MSCI China, we do still see upside out to March 2016, but it's only about 4 or 5% upside. Whereas, for example, if you look at our Indian targets, Sensex at 32,000, for example, we've got mid-teens upside, so hence the overweight on India.
The IPO market in China, and the anticipation is that perhaps we could see about 50 IPOs a month. That is what is being looked at this point in time. How much liquidity could that suck in?
Well, it's an extraordinary thing. I mean, China's equity markets onshore are trading as much as those in the United States at the moment, so about 250, 300 billion US dollars per day. And we're seeing very large IPO and secondary market volume issuance going through right now as the domestic investor re-engages with equities. And some of that may actually be about this transition to a consumption and services-driven growth. For all that there are problems in the industrial capital spending part of China's economy, the consumer economy, as far as we can tell, the mass consumer economy, is still doing okay. And the incomes generated in that economy, the urban middle class, are discovering the stock market. So it's kind of hard to judge. It's always a chicken and egg thing between equity supply and equity demand. But at the moment, the IPOs have been reasonably well absorbed. But there is a very big calendar of them. There are 484 companies registered with the CSRC to do IPOs.
India is nowhere close to that, but do you see a revival of the IPO market in India as well? And also a question on the government's disinvestment program, because they've set out a very ambitious target. We've never actually met those disinvestment targets in India. But do you feel more confident about the government being able to achieve the disinvestment numbers and the enthusiasm with regards to the government paper?
I think it's really important developing an equity culture and actually having functioning equity and bond markets, corporate and government bond markets, as well as bank lending markets, is crucial to economic development. In China's government case, they made that very clear in their third plenary announcements at the end of 2013. I think Mr. Modi has been pretty clear about the importance of the disinvestment program, government disinvestment program. And as that happens and government's share in the economy begins to shrink somewhat, that allows more space for the private sector to grow, and that must mean more IPOs. And we'd certainly be hoping to see that from India.
Speaking specifically about India and the unfinished reform agenda at this point in time, and a lot of the reforms that we've just discussed, GST for instance, long-term structural reforms, but in the ease of doing business, when you speak with clients, when you speak with people that you're interacting who are looking at India at this point in time, do they say that they've seen any significant difference, any significant changes on the ground?
Well, some of those surveys that you mentioned, they poll business people on an annual basis, and so you want to observe improvements in trajectory over time. But it's certainly an area that India has been weak in historically. And so often what our foreign clients say is there are pockets of excellence in India, like some of the software and pharma companies and private financial institutions, but you don't have enough of a mass of the business sector that is able to perform well to help to drive growth. Now, the Make in India campaign, as it seems to us, and the willingness to attract inward FDI and to reform the functioning of the civil service, that should all help to improve the situation going forward. But it'll be a multi-year phenomenon. It won't be a 1 or 2 year phenomenon.
You talked about the private financials, and that's a sector that you like, but what about NPAs? Because the private sector financials have been relatively sort of unscathed as far as the NPA problem in India is concerned. The public sector banks are heavily burdened with that at this point in time. Do you believe that the NPA problem in that sense is largely over and done with, and we are going to get better performance on that front in India?
Yes, it would logically be the case if the economy improves that we should have seen a peak there, and that they should, that burden should fall going forward, but it won't fall very rapidly. A point that my colleague Anil Agarwal makes, who covers the sector for us, is that in India's case, the regulator has made the banks recognise non-performing assets, non-performing loans relatively early on compared to other countries in Asia. And that does give investors some confidence, but ultimately he prefers the private sector financials to the public sector ones.
Going back again to the macro stories, and the corporate earnings will be linked directly to the kind of pace of recovery that we see as far as the economy is concerned. If we have another bad monsoon, if we see oil prices move higher than 70, 75, do you believe that the ability to really see a resurgence in corporate earnings, which is being estimated maybe 2016 and full-blown recovery in 2017, that will be pushed back further?
Yeah, so you've sketched out a bear scenario, and we always at Morgan Stanley do bull, base and bear scenarios. But for us, the interesting thing is that the bull and base scenarios that we have for India somewhat overmatch that bear scenario. But we're certainly aware that it could happen.
So continue to be as bullish as you were, in fact, more bullish than you were a couple of weeks ago on India.
Yes, well, more bullish, because we put it as our top pick as of just of last Thursday. So that's the market we really want clients to focus on right now.
And, let me end by asking you, because a lot of people that we've been speaking to, some who see this short-term correction as a reason to exit the Indian market, saying that, the euphoria has played out, the exuberance has played out, and the others who believe that it's better to stay invested because India is a long-term trade. It's not a long-term trade, it's a long-term investment story. And you continue to believe that whether it's from a reform perspective, it's about structural corrections, the Indian economy is moving in the right direction, which will obviously mean significant returns for the Indian equity markets as well.
So if you look at things like credit to GDP, or you look at long-run demography, India's got just about the best story going forward of any of the large countries that we cover. But now it has a government that should actually allow some of that untapped potential to take place in terms of driving the economy over a number of years going forward. And you get, I guess, a second chance to buy here because of the derating of the market. Effectively, you wound the clock back in relative valuations to November 2013, kind of 6 months before the election. So you've got a second opportunity here. Second
opportunity to buy. Besides India, what else is looking good to you on the emerging market side? China, you're equal weight. Taiwan, you're overweight now. What else is looking good to you?
So Taiwan and Singapore are the other two overweights that we have alongside India, but with a lesser degree of overweighting than for India. And we're balancing that out against the underweights that we have on Brazil, South Africa, and in fact Korea.
Jonathan, thank you very much for speaking to us on CNBC TV 18. Appreciate your time.
Yeah, very much enjoyed it. Thank you.